I am Kevin Flynn of Avalon Asset Management Company. A question I get asked a lot these days, although not as much as a week ago, is whether or not people should be getting into the stock market now, here in the summer of 2013. So I've prepared this video presentation on the subject in the hopes that it might be of some help. Now, whether or not you should be getting into the stock market right now depends on who you are and what your goals are. I realize that that kind of answer is not the one most of you are looking for, so let me add that the short answer is probably not. It's not to say that the market is going to keep going straight down from here. Stocks could still put in another high this year, even rise another 5 to 10% from current levels before it's all over. And if that's the case, it's natural to wonder, well, why not jump in? So let me come back to my original point. It depends on who you are. Downhill ski courses at the Olympics, for example, are very fast and true, in theory, but they're not for everyone. In the same vein, if you're a professional trader or money manager, there's still money to be made in this market. But the trick is going to be knowing when to get out, and that's not easy, even for the pros. Ever seen one of those spectacular wipeouts during a downhill ski competition? That's what you get when everyone's trying to be first. But let's imagine for a moment that we have a real working crystal ball and that we could look into it and it would tell us that the high on the S&P this year will be 1750. That's about 10% higher from today. I know and have known lots of investors and traders over the years who would say, okay, great, I'm in. And then when we get to 1750 this year, I'm out. That's my exit point. But then they don't. Because when the S&P does get to 1750, everyone is talking about stocks. And after all, the market could go higher, and I'd feel so foolish if I bailed on the market now and it went up another 5 or 10% by the end of the year. I mean, I don't want to be inflexible, right? Inflexible has to be a losing strategy. So I'll compromise. I'll hold until 1850. That feels better. You see, I can be a disciplined investor. And I want to be first. But then the market goes down instead, back to 1700. Well, maybe I could have sold, but there was no way of knowing. I'll buy this dip like my broker says, and then when it gets back to 1750, I'll definitely get out then. And instead it falls to 1600, back where they first put their money in. And they think, well, I can't pull my money out now after this big correction. That'd be just stupid. Didn't all those famous investors say to buy when there's blood in the streets? So the market rallies a couple of percent. Do you feel vindicated? And then it drops to 1450. What's going on? We're down almost 20% from the high. I've lost almost 15% of my investment. If I bail now, I'll never get my money back. And then it goes down some more. It drops below 1,000. And the torture begins. It goes to 990, 980, and 950. And they say, that's it. I can't take it anymore. This is all a big joke. It's a fix. I'll never invest in the stock market again. And they get out with their 40% loss right at the moment they should be buying again. 5 or 6 years later, the market's back to 1800 and the other guy is making all the money again. Guess what happens next? When this bull market began in March of 2009, the pessimism was so bad that all it took was for one thing to finally start going right, and the markets put on a big reversal. But now we're near the other end of the pendulum swing, where the optimism has been so strong recently that nearly everything has to keep going right to keep this market going. The stock market's in a pullback now, but the overall bull market move since 2009 is getting old. Europe has to find a solution to its recession. Greece's problems are still out there. China has to find a solution to its credit bubble. We need to finesse another debt battle and avoid war in the Middle East, maybe while oil prices are spiraling out of control, and everyone's forecasts for the global and U.S. economies keep going down, at least for this year. And the Fed has just put a big dent in the easy money means easy profits in stocks theory. Now, all of those problems can get fixed, but politicians don't like to make hard choices until a crisis forces one on them. Usually the house is already burning down by then. Sometimes they don't always get the first choice right, or even the second. And even then, it usually takes some time to put out the fire. So if you have been underinvested in the stock market up until now, I'm sorry, but it's not the time to increase your exposure. If you are more than 70% invested in equities, I would gradually reduce exposure into any more strength. Don't think that you'll know the day of the top, because you won't. The start of every big sell-off is almost always followed by an immediate counter rally. The only one that wasn't was the crash of 1987, and that gave you about 10 minutes to get out. Speaking of that crash, I went all cash in July of that year, and then I watched the markets go up for 2 more months. But do you think I regret it now? The markets could go up again right after I post this video. You can't time the market day to day or week to week, but you can avoid buying when everything needs to go right. You could also hire an independent financial advisor whose job doesn't depend on you doing trades or staying fully invested all the time in house products. If you're stuck with 401k choices once a quarter, well, wait until there's more clarity, like much cheaper prices. Our policymakers have actually fixed something, and hang on to your cash. You'll get another chance, and it will be a better one after the crisis. I'm Kevin Flynn, and I hope that this presentation has helped.